Hi, welcome to SuperInvestors' where we discover and connect with the top 1% investors. Today we have with us Mr. Nitya Shah and Mr. Aniket Kulkarni, the co-founders and directors of KamayaKya, a SEBI-registered research analyst firm based out of Pune. Their portfolio has delivered around 60% returns in the last 9 months. In this podcast, they reveal their framework to identify hidden value gems that have been overlooked by the market. They also share some interesting insights on emerging themes such as luxury, chemicals, and logistics. So, without much ado, let's get started.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Registration granted by SEBI, membership of BASL and certification from NISM in no way guarantee performance of the intermediary or provide any assurance of returns to investors. The securities quoted are for illustration only and are not recommendatory unless specifically mentioned.
Thanks, Aniket, for the disclosure. Welcome, both of you, Aniket and Nitya, to the Super Investors podcast. Very thrilled to have you both here in this conversation.
So thank you so much for having us here. So I'll just give you a brief background. We are based in Pune. KamayaKya Wealth Management was started in October 2022. That's when we launched our website. So my dad, Dhiren Shah, has been into investments now since the last 30 years or so. So he mentored us throughout, and I was working at another investment advisory for the last 2 years. And after a point, I had a discussion with my dad. Aniket was already working with my dad for our family office portfolio, where they would do research for that. And then we decided that we can, take the formal step of taking the SEBI registration and begin a firm where we could serve clients, because I noticed that there was a gap in the micro and small cap research segment. Like these stocks, even though the potential was strong, no one would really look at them because liquidity would sometimes be an issue, or there's just not enough information available. Like maybe the management is not available to interact with the investors, and basically there's a lack. There's like less data available. So we thought that my dad over the years specialized in this for his own personal portfolio. So he taught me the frameworks of how to go about it, and then my education in CFA and whatever else also I learned, it helped me apply that in equities. So we decided to start this firm. So now we have a 5-man strong research team. Aniket and me run the organization at present, and my dad is in a mentorship position. So our focus has always been completely on fundamentals. We don't do any technicals or futures and options. We just stick to what's going on in that company, what's going on in the business. Is it facing any tailwinds? Can the future be profitable for them? So I would say we don't really worry much about what the index is today and so on and so forth. Because I've realized a lot of times the index is heavyweight on financials. So it doesn't really affect a lot of the companies where we are invested. So we just try and take a business view, what is happening in that company, and take it forward from there. So now it's been a year, we've got our own research service, and we also have a small case, as you had mentioned. So it's called value buy opportunities because we are market cap agnostic. Like we might have a very large company, and we might also have a complete micro cap. So going forward, I might take a few names of companies in the podcast, but none of it is a recommendation in any way. It's just for giving an illustratory example or something of the sort.
Absolutely.
So that's basically my background.
Sure, thanks. How about you, Aniket?
Yeah. So basically, I am an entrepreneur for the last 11 years. I started off in a social networking website for Manchester United fans, which we eventually converted into e-commerce store, wherein we had like over 7.5 lakh followers on our various social media channels, and eventually I sold it off. Currently, I started investing in 2017, but I got into active investing since 2020, and I started learning specifically about small cap investing and frameworks from Mr. Dhiren Shah, Nitya's father. And we started working together in 2020. We applied for the license in 2021 when the company was formed, and we got the license in June 2022. the RE license, and we launched our website in October. And like Nitya mentioned, even the small case we launched in April. So yeah, this has been the journey so far. It's very exciting to be in the markets. You get to learn a lot about how businesses work, how the economics work. You need to be updated about everything because everything is interconnected. So it's a very interesting field to be in, and I'm glad to be here on this call with you.
Sure, glad to have you both as well in the conversation. So, can you please explain to our listeners the investment strategy of your portfolio and the stock selection process you employ in your team?
Sure. We do both top down and bottom up depending on what the company is doing. So sometimes we might be reading a lot of news. So say if any particular sector seems to have a lot of tailwinds, we start investigating there that who could fit this theme or who are the ancillaries to this theme. And we also use a lot of tools. So our team uses Ace Equity, Screener, Tejori, CMI. So we get a lot of data. So on basis of whatever we screen, we have our own parameters. So once we run that, we come up with a list of stocks and then we begin to deep dive. So these tools are actually a really big boon for us because it helps us filter out a lot of companies which cannot be covered under our universe. So I would say we are very valuation oriented and we look at growth at a reasonable price. So that's largely what we are always focusing on. And our company that we are investing in should be doing something that has a USP or a moat, as they say in our industry. So especially since we are slightly tilted towards small caps because as I said, we focus on where things have value. Usually you will notice, like this is according to me, that in the large caps it's usually just a perception problem. Like all the data is freely available, but like the imperfections are fewer. In small caps, you might notice that what the price should be and what it is have a lot of asymmetry. So we try and figure out if that company is doing something specific where it can take it to a scale of that level. Because if a small company is doing something that a large company is already doing, your unit economics are not going to be comparable because a large company will always be able to defeat you when it comes to pricing and profitability and all of that. So there needs to be a niche in some way. So we look at companies with high gross margins, high operating margins, and who can allocate capital well. Like return on capital employed becomes a very important metric for us, and we try and do it on a forward basis. So looking at return on capital employed on a past basis can be very very skewed or biased at times. So we try and see what can come forward. So from our experience, we've noticed the markets tend to price in 2 to 3 years of forward growth or earnings into today's price. So we are not very spreadsheet oriented investors. Like I will not run an entire DCF on a company because I've personally noticed that DCFs are more for mature companies, and for small cap companies, when they are growing, your working capital can be all over the place and your operating cash flow can be very, very skewed in 1 year and in the next year be something completely different. So it doesn't become comparable. So we use a technique called reverse DCF to try and see what is priced into the stock today as per our expectations. So that's another way we look at valuations. Then my team focuses a lot on deep down fundamental research. We look at everything like who are the suppliers, who are the clients, are they doing any capacity expansions, what is their debt position today, how are they utilizing their working capital, is the inventory being able to be churned fast, then what is the promoter's skin in the game. So we prefer promoters who have a larger stake in the business because by the end of it, it's all about the management. If the management can execute, you will do well eventually. Like we also pay a lot of attention to what guidance the management has given in the past and what they have actually performed. So when we take a calculation of the deviation between the two, it gives us an idea of how much to discount what a particular promoter is saying. Because sometimes promoters tend to be very, very optimistic, and sometimes promoters might not give you any guidance at all. So that's where like your judgment over the years comes through, that when you have tracked the business for a while, it really helps. And plus, since my dad has a lot of experience, he's had a look at these companies before. His tactical ideas help us a lot in identifying whether we are on the right track or not. Then on-ground reality is something which we focus on heavily. So our research team likes to always visit the management, visit the factories. So if it's a product-based company where we can actually see their work, we visit their showrooms, have a word with their dealers, distributors to actually get a ground reality. So you can, compare what the management is saying and what is actually happening on the ground, and that helps you build a lot more conviction. Like I'll just give you an example. So there's this company called Carousel, which is into kitchen sinks. Okay, they make quartz kitchen sinks. So we studied the entire company. We thought that they are doing something very interesting. Like they are not over expensive like your Franke and Blanco, and they are also catering to, I would say, India moving towards a luxury kind of themes. So we studied, obviously, we went through all the con calls, we interacted with the management, did a deep dive on their financials, everything looked good. But then the conviction actually came when I personally went to 4 or 5 of their showrooms, had a word with their staff, saw their product, and I liked it enough to have one in my own house too. So that's when it'll give you enough belief to invest in such companies. So even very subtle things like looking at what the web traffic is for a particular website, how is their digital marketing, like these small qualitative factors can sometimes completely change the picture. So people tend to go very bookish. I've noticed at times, and sometimes these small things can become a trigger for you to invest. Like when you see a particular marketing activity that can really I would say create a recall in someone's mind, that becomes very important for us because I'm from a younger Gen Z kind of generation. So for us, digital marketing becomes very important because the attention spans are very, very low. Like if you're not able to catch my attention in those 3 seconds, you've already missed me. So how the company is, going out there in the public and interacting becomes very, very important. So that's largely our framework. It's basically just understanding the business model really, really in depth. Until we don't understand that, we cannot invest. Because they always say that valuations, it's based on the business. If you don't understand the business, how will you value it? So we've always focused on understanding that at the core and then taking things forward. So that's largely our basic strategy of how we go about it.
Sure. Aniket, would you like to add anything more to that?
No, I think Nitya has covered most of the things. Just a few more additions would be like, checking out employee reviews on Glassdoor. So, but I mean, that's all a part of how we can find on-ground reality, which is a part of like scuttlebutt investing, which we believe in a lot. We also do a lot of plant visits, go and meet a lot of managements, and then try and also meet the suppliers, distributors to try and get what if the management, what they have said is actually true or not. So that is one of the most important parts. Secondly, what is happening in the industry as well is a very, very important thing. Is the industry facing a tailwind? Is it facing a headwind? Also, in that industry, how can our company or the company that we focus on can grab more market share compared to its competitors? So those are the things that we need to see when we are, investing. So yeah, I think most of the points have been covered by Nitya.
So I would like to understand what are your risk management techniques given that your portfolio is operating in more of a volatile market cap?
Yeah, so that's a very valid question. So, as I told you, we always enter where we see some margin of safety. So, I would not invest in things where I already know a lot is priced in. Like, for example, when we run a reverse DCF and it shows me on a 5 year basis that your implied earnings growth is north of 30%, you're already entering in a very heated kind of valuation. Where if the company does not deliver this, your valuations are going to get derated. And I do not like drawdowns exceeding 15%. It means that if you entered at 100 and it's gone to 85 right after, your entry has been wrong. You've not evaluated the business correctly. So when it comes to volatility, we basically take it in the way that if we are investing with a particular set of triggers, if those triggers do not play out, you have to take a call as to how to proceed. That means you have gone wrong. So we always decide to move away from that company, get out of it if our thesis has not played out. So one way to deal with it is that if your research is very in depth, if you've interacted with the management, you've understood the business very well, you've done your channel checks, like it has to be a very adverse or an unexpected or unforeseen event which has caused that. So say when there's a black swan event like say COVID or any war happened, and those corrections come in, those are actually an opportunity for you to buy because it has nothing to do with the company. It's just clear panic selling that's going on in the market, and that actually might give you a chance to load up some more. But if the markets are all stable and the company is underperforming for some reason, that becomes a reason to check that what has gone wrong in our framework. So we keep reviewing it accordingly, and currently the markets are in a bullish phase. So the chances of anything adverse happening other than the market means your company has done something really peculiar or something has not worked in their favor. So volatility becomes important, and even in our small case, we have diversified to a decent amount. We usually don't do more than two stocks in one sector. Our small case is equi-weighted, so currently we have 16 stocks. So we are not overly concentrated on one stock. So that helps us deal with volatility. We also have a couple of large caps in the small case. Like as I told you, we are market cap agnostic. So let me just give you an example. We had done Tata Motors, but the DVR a couple of months ago. So our analysis was, so I have a few friends who work in the auto ancillary industry. So one of them was making the gearboxes for Tata Motors commercial vehicles. And I met him outside a couple of times, and he was just telling me that the demand has been so robust that he has to do a capex to cater to Tata Motors requirements. So that's when I, began digging into the company, and I also spoke to another one of my dad's friends who's into the same thing, and even he said that the order books were really piling up. So these leading indicators helped us a lot. Then I realized that I'll just give you an explanation. So there are ordinary Tata Motor shares and there's differential voting right shares. So the advantage you get in a differential voting right share is that you get 5% more dividend than the ordinary share. Because you've sacrificed the voting rights. So for example, if Tata Motors is getting 1 rupee of dividend, the DVR will get 1.05 rupees of dividend. And since 2016, Tata Motors had not paid dividends due to their JLR division underperforming. There were tons of global issues. There was a chip issue. Then Brexit happened. So their business was facing issues abroad, especially in China and the UK. So due to that, we were seeing a lot of margin of safety in Tata Motors. When we saw their result last year, we finally saw that a turn was coming. It was years of pain, and they had controlled cash flow very well. So we saw that if they manage to maintain these level of cash flows in the next 2 to 3 years, they could be net debt free. And that's something which their chairman also said in his speech. So I realized that, Tata Motors chairman, Tata Group chairman saying such a thing, you cannot take it lightly. He's clearly thought about what he is saying and he is going to do it. Otherwise, he wouldn't say it in open public. So we did a deep dive. We saw that there was a clear valuation arbitrage between the DVR and the ordinary share. So when Tata Motors used to pay dividends regularly, there was a 25 to 30% discount between the two. And currently, since 6 years, you are getting no dividend, which basically means your DVR is not serving its purpose. You were getting it at a 50% discount due to that. So our bet was that we are focusing when can the company become dividend paying once again. So we had a complete financial check. We understood everything, looking at their projections, con call, all of that. We saw that they will generate enough cash flows where they will be able to give you a small amount of dividend. And our thesis worked out correctly. They announced a dividend, and that's when the stock started to re-rate, where the discount began coming down. So later on, much to our surprise, to simplify the capital structure, they also decided to convert the DVR shares to ordinary shares. So they gave a ratio which also technically gave you a pricing of what the voting right was worth. So it came to 50 rupees, the value of the share after the dividends were paid and this conversion was announced. And our entry was much earlier. So we had entered at around about 320 rupees, if I recollect correctly. And we got the advantage of this. And then they continued a very strong performance in the coming few quarters also. So even in large caps, sometimes there can be a perception issue. Like here, everyone had a perception that JLR cannot turn, but we saw so much value because of that. Like you're getting one of India's best car companies below one-time sales. Like, it's a clear margin of safety criteria over there. So we just played into that. for us. Same way, even in small caps, we just look at valuations where things are, criminally undervalued and they have a large potential of, re-rating eventually. So usually we make our money when there's margin expansion and PE re-rating. Those are the two primary factors which we take into concern. If you're able to manage to play out an operating leverage, means you have a clear moat. Otherwise, it would not be possible. So that's how we usually deal with all of this.
Sure. You repeatedly kept talking about reverse DCF concept, right?
Yeah.
So I think it's a concept devised by Michael Mabuse, the professor. So for our
Right.
listeners, would you be, throw some more light on how exactly would you approach that for your investments?
Yeah, so reverse DCF, how we do it is that depending on each company, like what would be the right metric to evaluate. Sometimes the cash flows might be in a way where we can't input that into the reverse DCF. So on Tejori, they have a nice reverse DCF calculator. So depending on business, sometimes I take EBITDA. Okay, so for example, in Jupiter Wagons, another company which we had played in the past, we had done a reverse DCF where we saw that the earnings growth was implied was more than 30%. So how we did it is usually you choose a discount rate that is usually a opportunity cost. So for small caps, I usually choose either a 14 or 15% discount rate to be as conservative as possible. So we decided to use the EBITDA factor into it. We predicted a 25% earnings growth for the next 5 years. And after you input the discount rate of say 15%, it shows you on a 5-year basis what is the implied earnings growth. So we saw that we had assumed 25% as per our calculations, and this was showing us north of 30%. So the prices built in today were quite heavy. So reverse DCF is just more of like it gives you an insight of how far off are you with your expectations over a long period of time. Like if the expectations built in are too heavy, you need to be very careful because if even one quarter is not as per what the market expects, they are going to derate the stock heavily because the expectations built in are too heavy. So reverse DCF, you can experiment with it quite a lot. You can change the terminal growth rates. You can use a lower discount rate. But I personally feel it's always better to be conservative. So we decide to take a 14 to 15% discount rate for small caps. For large caps, I would say 11 to 12% is usually what we go with for a discount rate. So it's a very good tool. It's definitely helped me a lot over the years.
Sure, I think it will be helpful for our listeners as well. Given that in 2023, we've been experiencing a bull run and still we are experiencing it, right? Nifty was touching all-time high frequently. So what's going to be your team's outlook for this calendar year?
So basically, as mentioned earlier, we do not look at indexes or how the broad markets are going to perform. We look very stock specific, industry specific, what is happening, in a particular company or in an industry. Like because we go top down and bottom up as well. So considering how the markets have performed, we feel there are certain pockets which are very overvalued, some which are slightly overvalued, some which are fairly valued, and a very small percentage which is undervalued. So right now our focus is to find companies which are fairly valued and undervalued, which can have high growth prospects. Right now, for these, there need to be certain. Now, why will a company's valuations be at the lower end? Usually, that would only happen if they have faced certain issues over the last 1 to 2 years. Now, those issues could be demand issue, it could be high raw material pricing issue, it could be a destocking issue. There could be certain particular issues that could be there which are hampering the company's performance, because of which the price is currently on the lower end. So our focus right now is on finding companies which can be a turnaround for the next 1 to 2 years, because that is where we can find more value. Apart from that, of course, we are always going to be on the hunt for moated companies with competitive advantages which can grow faster than the competitors, but at the right price point. So that is what our philosophy is going for the next 2 years. I think Nitya can also add more to it.
Yeah, so as Aniket said, we don't focus much on the index. We try and see company specific, right? So I've actually off late, since the markets are so heated, I've started running reverse screeners, like where the companies are facing severe headwinds, like where the sales growth is below 10 or gone below zero, or the margins have derated, or they've done a capex at the wrong time. For example, you've onboarded a complete capacity when your demand scenario is very, very weak. So we try and look at these companies where the capacity utilization has fallen severely, and going forward, can it improve? Because as your utilization increases, your unit economics will improve. So now actually I started employing a reverse framework, because if you put a normal framework, you're not going to get anything that's of your kind of value, like that will fit in your framework. So for that reason, we've started, using a different kind of approach. Like earlier, we would never do this, but you have to adapt whenever there are changes in the market, right? If you don't adapt, you will miss out. So that's something that's worked for us quite well, where we are analyzing companies which are facing issues. So that becomes the real research, because you have to really understand if the comeback can come or not. Because the companies, to maintain their stock price, will give you a bullish outlook on the con call. They'll be like, things are improving, things will come back. But that's where your channel checks help. You have to actually speak to people from the industry who know what is going on. And like, say for example, chemicals, like I'm not a chemical engineer. I don't know the names of chemicals. I'm not going to be able to understand. Like, say if a promoter was able to tell me about a particular chemical, I would not know whether he is saying the absolute truth or not. So I would have to verify this with my industry sources who understand the subject very well. So I take a lot of help from people who are from the domain, like who maybe know nothing about finance at all, but about that product they are experts. So that really helps me gain some valuable insight. So that's one part. And now I've started focusing on companies where the balance sheets are strong. So I don't want extremely levered balance sheets. A net debt balance sheet or something that's moving towards net debt is what we are looking at. And companies where the capacity is already onboarded is where, like, usually we tend to enter either one quarter prior to the capex or one quarter after the capex has been completed, depending on the scenario. If we feel that the price we are getting prior to the capex is very favorable, we'll take it then. Because usually what happens is that companies face some operational expenses in the first quarter after the capex is onboarded. So their margins might be slightly subdued one quarter after the capex, after which they begin to improve as their utilization picks up. So that's largely how we are approaching the markets now, because they are slightly heated. So you have to take a complete opposite approach at present. Look at companies where no one's talking about. Like in my personal opinion, I felt that agrochemicals and chemicals were facing a lot of headwinds over the last few quarters. So I felt that themes such as, say, defense or railways, very good themes, but for a person who's investing today, would it be the right valuation? I'm not very sure, right? Because it depends on like what your investment time frame is. So I feel that if I'm investing for a client today, and for 1 year he is not earning anything, he is immediately going to compare you with any other person who's managing money or any other asset class. कि अगर मैंने यहाँ पे पैसे डाल दिए होते तो मेरा इतना पैसा बन जाता. But so I can't let that happen. So we always invest where in 1 year time frame the triggers can play out in a way where you're making some money. So that's how I've started looking at the markets at present.
Sure. I think you talked about luxury as a theme playing out
Yeah.
in India with
Right.
Karaisel, right? So would you be
Right.
able to share about an investment thesis for any themes or sectors or any pockets of investments that you're currently bullish on?
So luxury is something I've been, bullish on for quite a few years, because I've realized that India is moving towards a aspirational kind of lifestyle. Everyone wants to, move towards a better kind of lifestyle. I've always believed, data never lies. Like the narrative can be one thing, but match it with the numbers. So I was just noticing numbers in general. So over the last few years, you see there's a big uptake in the number of BMWs, Audis, Mercedes sold, Range Rovers sold. Everything is growing. So that clearly shows India is moving towards an aspirational lifestyle. If you look at the luxury home sales, I just read DLF managed to sell out one of their projects in like record time. Like people are lapping it up like nothing. So in 3 days, 865 million worth of $865 million worth of real estate was
Developers.
sold in 3 days, luxury real estate. Now that's saying something, right? You're heading towards $1 billion of luxury real estate sales in 3 days. That means look at the amount of demand that's being generated. Like even Jaguar Land Rover, they showed, like, say, if you compared, say, the November month of this year, say 2023 November versus 2022 November, there was 100% plus growth. So you notice that a lot of luxury brands abroad are beginning to come to India. Like, say, for example, Christian Dior did a big show. Uh, then Alia Bhatt and Deepika Padukone were onboarded as brand ambassadors. So we are being put on the map, right? So I can clearly see, like, if you just roam around in general, you go out to places, the way people dress, people are, moving towards better brands. People are spending heavily now, like thanks to UPI and all the other benefits, like you're able to avail credit also much easily of late. So we are moving towards a consumption-based economy where people are looking to spend. So India was known to have a savings culture throughout, but the newer generation is moving towards spending more and more. Like that's clearly evident in the numbers also, and when I go out and see, I can see it there too. Like everyone's lifestyle has started to progress towards a higher level, like as a developed economy would. So say right now we are in a developing economy stage where we are say at 2500 GDP per capita. So as what history says is that when you reach that 2500 GDP per capita, you're moving towards a golden phase in your economy. So if you can play out that delta from $2,500 to say $10,000 of per capita income, your entire economy is moving towards higher consumption and a better quality of life. So there's multiple insights I can share. Like I was just reading even in the alcohol space, like Mrs. Hina Nagarajan in the United Spirits, she's the chairman of United Spirits. She's also said that she doesn't want India to drink more, she wants them to drink better, like have better quality alcohol. So I was just reading Rampur single malt whiskey, they are facing inventory issues because there's so much demand for it, they are not able to cater to the demand. I read that Gurgaon in a particular number of days had gulped around about 12 lakh liters worth of alcohol. So the volume growth in alcohol companies in the prestige and above segment is really picking up. I'm able to see that in the numbers. I'm not just saying this as per what I have seen. The numbers are telling me this. So India is definitely moving towards a better life. I can like see that very, very clearly. So there's so many companies who are beginning to focus on India and they never had their sights on India before. We are manufacturing for Apple, like, even though it might just be assembling, but at least it's a start. So now maybe we are somewhere where China was 20 years ago. And the good thing about history is you learn what not to do also. The mistakes what other countries have made, maybe what China took 20 years to do, we can maybe try and improve on that in certain ways because we've seen what challenges can come up over time and so on and so forth. So everyone's selling the India story very, very strongly, right? So the narrative is one thing and the numbers are another thing. So luckily at present, both are working out in our favor. Like the moment the numbers start to deviate from the narrative is where you start being careful. That you see, so I don't look at GDP growth that much in depth. I look at GST collections. So GST collections is the right way to, I would say, assess consumption, not the GDP growth, because you can't. The GDP is so many variables. Like you can't take a clear call on basis of that. So I feel GST is something I pay very close attention to.
Just to add up to what Nitya said, so what are the luxury items, right? So if you are just to categorize, now there are more players entering into jewelry. There are more players entering into luxury watches. So the markets for luxury items is substantially increasing in India as the top 1% is making a lot of money in India. So that is how it is helping the consumption story. Of course, the current bull run is also helping the consumption story. People's incomes have also been rising at a decent level. So this is all helping individuals and to acquire more luxury items.
Then we've also seen that companies such as say Sula Vineyards also, I was just reading, their In one weekend, they did 2.5 crores of revenue from their resort in Nashik, and that's their all-time high. So their footfalls were at an all-time high. Imagica, Wonderla also showing high amounts of footfall with good growth. So all these discretionary consumption themes are working out very well. Like be it clothing, be it watches, as Aniket mentioned. I just saw that India has seen 20% growth of imports and luxury watches from Switzerland. So there's clear demand coming out. Like if we even study ethos, they've also shown some clear growth. So I just recently visited NMACC in Bombay, Nita Ambani's cultural center. So I saw that they've even started this thing called Remova, which is into bags. Like they've also started moving towards other kind of products such as luxury bags, and they're always on the lookout of what can work out next. So watches is something which even I feel can do very well, and all the ancillaries to real estate, like Carousel was one of them. Uh, then even Serra Sanitary Ware has been, picking up a lot of market share, good performance. So, like I personally don't look at real estate stocks specifically. Like for example, a DLF is not something I would probably invest in, but I will look at ancillary themes to it because they are easier to predict. Because real estate companies tend to have a lot of issues in their cash flows. Like it's tough to predict things over there. Like it depends on how much revenue is recognized, basis of the units sold and so on. So I find it a bit complicated. So we particularly try to avoid that. Like it's easier to play an ancillary.
To summarize, ancillaries to real estate, hotels, watches, and beverages would be like indirect ways to play on the luxury thing. Are there any contrarian bets on any particular sectors or pockets of investments your team has currently?
So we currently are focusing a lot on chemicals at the moment because what happened in the last 4 years. So basically in 2020 and 2021, when the world shut down, and especially China, because China is one of the biggest producers and exporters of chemicals. So that led to lot of companies buying excess material, lot of companies buying materials at unrealistic prices, because of which the chemical profits, revenues increased substantially in 2020 and 2021, which also reflects in their numbers and also in the share price. And the exact opposite cycle happened in 22 and 23 when the pricing started deteriorating because of the overstocking. The company started buying, the end user company started buying lesser chemicals. They started, the prices of the materials started coming down, which is why, as you would have seen, many of the chemical companies have either been not given any returns over the past 2 years or have given negative returns depending on how moated the company is. So that is one particular sector which we are focusing on for the next 1 to 2 years, which can make a comeback, because even in chemicals there are two type of companies. One is your pure commodity, and those are dependent on your prices. So if you get a good spread on those prices, you get a beneficial outcome, you get good results. Now, second type of company are your special moated companies, where there is a specific chemistry, or maybe they are diversified, but they are experts of those chemistries. So for anyone to come in and replicate those plants, replicate those products is very, very tough. So your competition risk is comparatively lesser there. And but again, because everyone knows that they are really, really good companies, they also command those superior valuations. So you need to find the right balance between how moated the companies, how good the growth prospects are, and how fair the valuations are. So that is one particular sector that we are focusing on. We are also finding a few interesting companies in the commodity chemicals segment. Apart from chemicals, some themes that we feel could actually take off in the next 1 to 2 years could be an aquaculture theme. It could also be a packaging theme. So aquaculture theme was facing a heavy demand issue because they are dependent on exports. And since restaurants and all were closed in 2020, 2021, they faced a major issue in terms of exporting to restaurants, which were one of the biggest markets. So now they have evolved. They are now creating ready-to-eat products, ready-to-cook products, which can become interesting going forward because now they will be direct to consumer. That is one theme. Again, packaging had an issue of oversupply where they built up a lot of capacities, and now because there is oversupply, the pricing pressures have come in. So, as and how that normalizes, we expect things to start coming back in the packaging segment as well. And yeah, Nitya, in case you want to speak on any specific sectors as such.
Yeah, so I think Aniket brought up a nice theme of aquaculture, definitely, when I think that there could be a cyclical turn over there. So, in cyclicals, you have to be very, very careful that you're actually entering at the bottom because a bottom can make a new bottom and you cannot mess up your understanding over there. So, we saw that in chemicals, people were saying that the bottom is here, the bottom is here, the bottom is here for 3 to 4 quarters together. Now, I actually feel that the bottom is here. So people can go wrong in these cyclicals because they are not easy to predict. There's so many global factors, like you might miss out on something which can actually have a pervasive effect. So shrimps definitely is something we are studying at the moment, but we have to still build our conviction on a stronger basis. I'm still not fully sure of what's going on because one is there's always a disease risk of the shrimps, and second is so Ecuador faced some issues due to weather, which might benefit India. But then see, there's another variable of anti-dumping duties or countervailing duties being imposed by the US on these countries who export to them. So if such things happen, it could really, really be a big problem for, say, the shrimp companies in India. So there's so many things to take care of. We have to take a very, very measured call. Like where I'm either getting the company at a complete throwaway, like say if I took it on a 10-year basis, I'm getting it at a much lower discount to a median multiple. That's when I would enter. Like so, the base rule of cyclicals is that you enter when the margin is negative and you exit when the margins go severely positive. So we have to just try and see, like that's where your channel checks come off a lot of views, where they can verify what you're thinking. So I've noticed a lot of times is that when I'm thinking about something, the ground reality is the exact opposite. So otherwise, if I wouldn't have done so, I would have made tons of mistakes. Like where you're like see the moment you're stuck in a bad cycle, you're not going to get out of it for a while. Like then you're just stuck there because you wouldn't want to sell at the bottom because that would cause you a severe capital loss. So getting stuck in a down cycle, I would say, can really, really ruin multiple years of return. So that's something we are very careful about. So yeah, that's how we've been approaching cyclicals.
Any views on the upcoming budget and sectors which can benefit from that?
So see, it's the election year which is coming up. So I think already a lot of spending has happened over the last few years. The government capex, public capex has picked up a lot. Now private capex has begun to pick up. So I am expecting that maybe since it's election year, a lot of subsidies towards agriculture could be given because I feel that food inflation is an issue. It needs to come down. So I'm expecting maybe the government intervenes here to control that. But other than that, I feel already the strategy has been clear of the government, to move towards infrastructure. So that's something that will continue doing well. I feel the allocation over there will be quite high. Even towards education, I think the national education policy, which was announced, there could be probably more announcements coming in there. The government setting up more institutions, so on and so forth. But I don't think the budget will be as big an event as it was last few years because already a lot of things, if you notice, the last few years have been announced. Like there's tons of work going on. Like anytime we travel by road, I'm always seeing something or the other being built. It's never like a simple day. Like in Pune itself, it's a headache to commute because there's work going on everywhere. So work is clearly happening. Like in Bombay also, I saw a lot of roads have come up. They are setting up some really nice long roads which would really reduce traffic time. So maybe logistics is also one theme which we might explore eventually. Like if efficiencies come up through this, like we can see a lot of improvement due to logistics. I think even the dedicated freight corridor is coming up soon. So that could be another interesting theme to look at.
Sure. Any investors that you look up to?
Yeah, so I feel that Siddharth Bhaiya of Equitas is someone who I relate to quite a lot. Like his thinking and my thinking matches quite often, and I'm liking the series he's began on, madness in the markets. So that's something that's quite insightful. I enjoy reading it because actually there's quite a lot of whack things going on in the market. So it's good when someone actually comes and begins a series on certain things. It opens the eyes of a lot of people. So I personally never write anything on forensics because it's better to just avoid those companies than going and writing about them. Why do you want to open a can of worms, right? So we just decide to avoid them instead. So we also notice very hilarious things happening in the markets at times. Like sometimes we notice, like I remember,
Bombay Oxygen. You remember the Bombay Oxygen?
I was just bringing that up. Like about a year and a half ago, there was this company called Bombay Oxygen. COVID's happening. This has nothing to do with oxygen cylinders, but the stock price has gone through the roof. So that's a clear example of madness in the markets. So I like his approach. He has a very no nonsense kind of approach. So that's something I like. Then I would say Mr. Ashish Kacholia is a brilliant investor. I really like his way of analyzing businesses. I would say my own dad also I look up to a lot. He would be my favorite investor if I had to say, because he's taught me everything I know today, 100%. So the way he's analyzed businesses has really brought a lot of insight into me because he's been a business owner last 30 years. So he doesn't look at stocks as a stock. He looks at it as a business. So the day he told me you will start looking at stocks as a business is when you'll actually learn how to invest. So I've always taken that into stride. Like he had invested in InfoEdge in 2009 after the financial crisis. He's held on to it till this day. So he entered at a 130 rupee stock price, and today it's at say 5,250. So compounding is something I've seen from him that can really work. You have to let things play out. Like he always told me कि हमारे business में कोई change लाना है तो at least एक साल जाएगा. Like you can't expect a company to say that we are doing so and next day you're going to see the change. Like you have to give companies the time to actually implement what they are saying. So I would say my dad I've learned a lot from. So having a mentor like him at home every day was a definite gift. That was one. And I would say lastly, so Mr. Sunil Singhania sir, I think even he's a legend of the Indian stock markets, done some really good work over the last few years. So these investors are someone who I can relate to, and like I feel that my thought process matches with them.
Aniket?
Yeah, just to add up, I think Nitya has covered most of the list that we have in common. Apart from that, I might just want to add maybe Arvind Kothari of Niveshaay. I mean, they are sort of like competitors for us, but we have extremely high respect. So it's like a mutual respect, right, for people who are doing good work. And so for one is him, even Samit Vartak of Sage One, we have been following. I have been following personally. So yeah, these are just a few people. So basically, as you would have heard, the names, these are not extremely well-known names, especially if you are focused on mid-cap, large-cap. These are very small-cap, SME, micro-cap oriented names, and that is because we also believe in the kind of philosophy, that as that very rightly mentioned in the beginning, these are tougher picks, right? Because they are not so established. You don't know how the particular industry is going to function, for example. But to actually have that information asymmetry and to have build that conviction, you need a different level of courage. So these people have shown it. They have created frameworks, they have created strategies which kind of also align with my personal strategies. So I think most of the names that Nitya said and the few names that I have said are the kind of names that we follow or respect in the industry.
Any interesting books or blogs or newsletters which you had come across recently which you want to share with all our listeners?
So see, I get the CMI industry outlook every day, so that's something which I read on a daily basis. I focus a lot on magazines actually. So I prefer not reading investing books. I like to see what's actually happening. So Business Today, Fortune India, Manufacturing Today, The Machinist. Uh, there's a lot of industry specific magazines such as Auto Components India. That's something which I look at. Then, attending exhibitions, expos. I feel these bring in a lot more insight than investing books. Like you're never going to learn investing unless you actually do it yourself. No book can teach you how to do that. It's your own experience that will actually, show you. So I prefer reading annual reports or magazines over investing books personally. So I would say all investors, like even when we interview people for hiring, so the first question I ask them is that do you read the newspaper every day? Do you read magazines? And you'll be surprised how many people don't actually. So I find that very surprising as an investor. That's one of the givens. You have to do that. So magazines have been a great source of a lot of my ideas that have come. Like I'll give you an example. There was this company called Gufic Biosciences. So it's a pharma company focusing on niche products. So in some magazine, I think it was some healthcare-oriented magazine, where I read that they were the first company in India to begin manufacturing Botox. So because of that magazine idea, today it's my biggest position in my personal portfolio. Just on that one idea, like you get that source and then you start digging deep. Then since we are SEBI registered, we managed to get access to speaking to the management because otherwise they might not entertain investors. Like I've noticed that if a company is not ready to meet you, they are not particularly interested in creating a valuation. Like that's how I would view it. Like if they really want to create something, they will never say no to meeting you because what's for them to lose, right? So unless you're obviously doing something very like secretive which you can't disclose, I understand. But there's some companies who just don't respond to you at all, and some who are very forthcoming. So that also becomes a leading indicator sometimes that how interested is a management in meeting you. I would also like to mention Tariq Hussein's newsletter. So it's called The Wrap. That's something I go through every Sunday. So he's done a nice curation of all the announcements that happen over the week. He sources them from the BSE and NSE. So when there's insider buying, insider selling, when any new capacity or some big announcement has come into a company. He also has a very nice feature called first con call and first presentation. So it shows companies who have recently started doing this practice. So I like, looking at such companies who've done maybe a presentation after 5 or 6 years. Like I found a few companies who've suddenly started doing this and they are really making a turnaround. And they never bothered interacting with investors prior to this. So that's another way I would say to, find new companies.
So I do have some YouTube recommendations and I also have some book recommendations. I agree with Nitya on the aspect that by reading the books, today's day you might not be able to invest, but what books are helpful is to understand the history. Like just one example, Thoughtful Investor by Mr. Basant Maheshwari has a history of all the crashes that have happened right from the 16th century. So you kind of understand that there is a, there is like, I don't know if even Ray Dalio had this thing of, how the things change, right? Changing world order. So even in the crashes, there is a specific, like a flow of things, and it's always mean reversion. Always has been, and I think it always will be. Just the conditions will be different, the time frames will be different because of course the times that were there in 16th century or maybe what was even there in the last decade of 20th century are not prevalent today, but the history does repeat itself. So those kind of insights are the things that you can get through certain books. So I would give you a few books like Thoughtful Investor by Basant Maheshwari. Again, I would recommend Indian books to begin with before going to say Mr. Warren Buffett or say Mr. Peter Lynch, because again, the markets have been slightly different. Of course, certain frameworks still remain the same, but I would first, because it will be easier for the person to understand the Indian context, you must have heard of those companies as compared to the US companies. So, Thoughtful Investor by Mr. Basant Maheshwari, Joys of Compounding by Gautam Baid. After that, I would recommend the One Up on the Wall Street by Peter Lynch, Essays of Warren Buffett, uh, Little Book of Common Sense Investing by John Bogle. So these are few of the books that I can recommend. Maybe we can send you a link of those as well. Apart from that, YouTube channels SOIC, Accidental Investor by Prince. These two are the ones that I very closely follow. and would highly recommend for people who want to get deeper insights into specific sectors, about how to invest, how to create your portfolios, and about getting information from the best people in the business. So these are some of the recommendations that I have, and in case I might have forgotten something, I will just send it to you via personal message, and you can maybe add it in the YouTube caption.
Yeah, and another recommendation, this is a must do, I would say, for anyone who's planning to enter. I remember in around 2019 is where I started reading Dr. Vijay Malik's blogs and articles. I would say that will teach you actual investing. Like the way he
True.
has analyzed things, gone into the nitty-gritties, that actually is what got me interested in all of this. So definitely Dr. Vijay Malik's website is a must do for all investors. Like even a few times when interns come to interview for us, like where we are hiring interns for a couple of months, we tell them that's something you have to definitely go through for a good amount of time, because it'll show you how to look at things and the depths at which you have to go. Like he might go through the last 15 years of annual reports and all of that. So Dr. Vijay Malik, I have a lot of respect for, like the way he's done things. I would definitely say anyone new should be reading his blogs instead. Like instead of having a look at futures and options and trading and all of that, it's better to actually learn how to analyze a business model. Like every business is very difficult and different to analyze. The metrics in each business are very different. So I've realized over time that the markets are a lot smarter than you. Money power always wins, and you have to be lucky to find mispricing. It happens very few times. So that's why even beating the markets is considered a big thing, right? For a reason, because the markets are supreme. You can't compete with that after a point. So fast money is something I feel like when I look at the options turnover of India or the frenzy that's going on in futures and options, it's actually quite worrisome to me, to be honest. That everyone's moving towards making that fast money. So that's, I've never done a F&O trade in my life till date. Neither has my dad, and no one in my team has either. So we've always just focused on doing that. I don't think anyone in my team has done any kind of F&O at all. So I've noticed in India this is pretty concerning, the rush that I'm seeing in the F&O markets. Like it's insightful also. That's why if you look at broking companies such as Angel One, they're doing really, really well. Like if you look at their metrics, they've really outperformed a lot of companies. Very impressive performance. So definitely, I would say that making money is not an easy task. It takes time. I would always stick to that. Yeah.
Sure, I
Also,
think. Yeah.
just to add up on that, what we say is our philosophy is more towards investing. If people are making money via trading, it's their own, personal thing. We cannot say what is right or wrong. Some things work for certain different people based on their own personalities. Some people like short-term investing, some people like long-term, some people like trading. It's all dependent on your personality. But the most money that because of traders who have made are brokers. That is a fact. So that is something very rightly portrayed, put forth by Nitya. Again, very one important thing which Nitya will also agree our entire team uses is forum.valuepicker.com. Anyone who comes to us for a job or a internship, we do check whether they do that. Again, the forum.valuepicker, it also is certainly an idea generation tool, but the most important way to decipher in that is how other investors are looking into the business. What metrics are they looking for? What sort of information they have given on a particular company? Like there are different ways how everyone would portray, right? Like how everyone would look at a particular company, or how they would look at a particular industry, or even the management for that matter, based on everyone's individual biases. So to get all that data there and to understand, oh, this is a metric I had missed while assessing this company. So these kind of insights is what a forum.value picker would also give you. Apart from Dr. Vijay Malik is a legend. So we would certainly highly recommend his content as well.
I believe markets are going to be the ultimate teacher for everybody in the long run. Today's conversation was really insightful. Thanks so much, Aniket and Nitya, for joining the conversation.
Thank you so much for having us over here.
Thank you. Thanks a lot.
Thank you, listeners. Hope you found the conversation insightful. If you had liked it, please show your support by sharing this with your friends. Do check out our website, superinvestors.club for more exciting updates on equity markets. Until next time, this is your host Srikumar signing off. Thank you.